Hey everybody, JJ here, back again with another Thursday of Zoom networking. We have an absolutely awesome guest speaker today. Just a really nice young lady. She is very, very knowledgeable at real estate, very, very knowledgeable about passive income. And her topic today is building passive income and all the ways in which you could do that. I'd like to introduce our guest speaker today, Terra Padgett. Tara, how are you?
I'm good, JJ. Thank you for having me. I have in my mind, it was all a round of applause, all the hand clapping, gestures going up.
There you go. Um, So let me ask you before we get started here, where in the country are you located?
I am in H-Town, Houston, Texas.
Wow, I've not yet been to Houston. I've been to a couple of towns, but not yet Houston. So that may be next on our list. Um, so let's get right to your topic today, building passive income. Um, for those that aren't aware, they might be a little bit newer in real estate investment. What does that mean?
Yeah, so to your question, yeah, I'm excited to walk everyone through today and just really no matter where they're starting, just being able to begin building passive income. And so to your question, just to define passive income really quickly, it basically passive income is money that comes in with minimal ongoing effort. It's created by like investments or assets or systems instead of your daily active labor. So we think of this as like the mailbox money or making money while you sleep or having your money work for you. Why does passive income matter? And really, it's your freedom. It's your time freedom. It's your freedom of options. It's your financial security freedom, your freedom of choices. It's all these things. So we're going to cover today a quick roadmap of the three core levels of building passive income. So whether we're starting small, going big, or what I believe is the true sweet spot in between. But of course, quick disclaimer before we dive in, this for informational purposes only. I'm sharing strategies and my experience. It is not intended to be financial, legal, or tax advice. Always do your own due diligence for your personal situation. Now, let's get into it. So if you're someone that says like, I don't have a lot of money, or maybe I'm just starting out, then my recommendation is utilize crowdfunding platforms. I mean, there are a plethora of them out there where you can invest in real estate with small dollar amounts. So, and small being anywhere from like $1, $10, $100, and up to maybe $1,000 minimums. So these here on the screen are just some of the crowdfunding platforms that are out there. These are some that I personally use. Some I haven't, but I'm familiar with. But with the little, say like $10, you can put your money to work and start earning passively. And the benefits here are really anyone can start. I mean, it's a great way to really just dip your toe in the water, get exposure, and ultimately build confidence in what you're investing in. So you're investing with such small amounts, so you're able to diversify a lot easier. Your capital is tied to real estate, which is, as we all know, a lot of us are real estate investors. It's a steady, strong asset class. There are no property management responsibilities, or if you've been a property manager or been a landlord, I should say there are no property management headaches when you are, just investing through these with these smaller amounts in crowdfunding platforms. You're not taking out loans. You're not chasing sellers. You're not chasing borrowers. It's 100% passive. So if you're starting out with say anywhere from like $1 to maybe $1,000 just to dip your toe in, whether you say, I don't know a whole lot about, passive investing, or I just don't have a lot of money. I would recommend utilizing these crowdfunding platforms to get started. But with that, here's also the reality when you're using these types of platforms. I mean, at $50 or $100, even if the deal performs well, I mean, you might only get a few bucks a month. So just investing $50 or $100, it's not going to really move the financial needle. And I mean, you'd really have to invest and reinvest consistently over and over and let compounding really work its magic over a longer period of time. And these platforms are often like pooling thousands of tiny amounts and thousands of tiny investors. So let's say your $50 stake isn't really going to carry much weight or carry much influence, with the property or the loan that you're investing in. And plus, you don't get the benefit of learning from others. I mean, we're in a group call right now to network and learn. You don't really get the benefit of learning from other seasoned investors or being part of a community, because really you just click the invest button. So utilizing these platforms, it really is more transactional than it is relationship driven when you're investing. So again, It's a way to start small. If you only got, maybe a dollar, $2 pocket change or whatnot, it's a way to start small. You're dipping your toe in the water and really proving the concept to yourself of like what you're doing and what you're investing in. On the other side of the spectrum, if you got, say, $50,000 or $100,000 to invest, you can go directly into large scale deals and syndications. That $50,000 or $100,000 is generally the minimum investment amount required to do a lot of these deals. And these are the country club, I'll use air quotes, the country club type deals and the bigger return potentials. I mean, you've got like the IRRs and the equity multiples and the cash on cash distributions, preferred returns, preferred equity, appreciation, depreciation. You can leverage tax strategies, 1031 exchanges, cost segregations, bonus depreciation, all of the different things. All of those things are involved and can come with, and you can utilize to your personal financial gain in a lot of these large scale funds and syndications. And we're talking all types of opportunities. So we're looking at multifamily complexes, self-storage portfolios, build-to-rent communities, land developments, car washes, marinas, all kinds of different asset classes and structures up and down the capital stack. But here's also the reality. It's a heavy lift if you're doing it alone or as a solo investor. I mean, you've got to build relationships with the various sponsors. You've got to vet them, analyze the market, understand the deal, conduct the due diligence, read the PPM, the private placement memorandums. A lot of times you need to be an accredited investor. So even if you have the money, if you have $50,000 or $100,000 to invest, you still may not be able to get into those deals if you're not accredited or what they consider sophisticated. And also, I mean, you're writing one big check often into one single deal. So all your eggs are really in one basket. And it is very hard to diversify for the vast majority, not for Zuckerbergs of the world, not for the Buffetts of the world, but for the vast majority of individuals. It is very hard to diversify when you're writing $50,000, $100,000 checks every month or every year even. I mean, so it can be high rewards, but it can also be high anxiety when you're putting that kind of capital, of your own personal capital, into these deals for the operator to work them and run them passively. So that brings me to what I call the sweet spot, and that's investing at the 5K and 10K range. So at this level, you're able to access institutional quality deals. You're able to diversify a lot easier across markets and asset classes and sponsors. You can have less capital in any one deal, lowering that anxiety level that we just talked about. You can benefit from the lower barriers to entry. So you can invest in those country club type of deals. You can gain access to, you can get insights and learn from other investors. You can share insights with them and help other investors. So you don't have to take on the heavy lift, all of doing it solo. But how, might you ask? If the typical minimum amounts required are anywhere from $50,000 or $100,000, my $5,000 or $10,000 alone won't allow me access. And I'm glad you asked, because you're right. Your $5,000, $10,000 alone, it really won't allow you access to many of these deals. But there is an option. Get into an investment club. And that's exactly what I've set up with Power Pool Fund. I'm one club. There are others out there if you look them up. And that you don't have to be in the same city or town, because a lot of times we meet virtually. But with the investment club model, we're putting our capital together in those sweet spot levels at 5K, 10K, and then writing one larger check amount to invest in a deal. So you can access all those different commercial asset classes by doing it as a group. This helps to basically mitigate your downside risk. You still get your share of the returns. You can build your personal portfolio a lot faster. And ultimately, you're creating passive income. I mean, that's the power in pooling our funds. And so, for example, for a deal example, we just mentioned it, but has anyone heard of the Always Capital Fund? Just throw up a reaction in the chat if you've heard of the Always Capital Fund. So high level, from my understanding, what I know about the fund, it is a debt fund. They issue loans, primarily to residential developers, and they have a $25,000 minimum commitment. And investors earn interest, maybe 10 or 12%, but investors earn interest on their invested capital. So that debt fund is a type of deal we would review and vet within the club. So we'd review the offering memorandum or the pitch deck. We would have a Q&A with the sponsor. Then we would also discuss the deal just amongst ourselves, do our own personal due diligence and financial things to see if we're able individually, if you're able to invest in the deal. So talking with the sponsor, getting your questions answered, discussing it amongst other investors that have done deals similar to like this. And so within our club, within Power Pool Fund, and let's just say we had 10 people with 10K. And that each wanted to invest in that deal. So pooling that together at 10K a pop, that's a $100,000 investment that we could do as a group into that fund. And so we would all vet the deal together. Once we pool the capital, we would invest it together. And it's really a way to lower your capital outlay, to lower your capital risk, still bigger than, the $10, $20 that you're putting into, the crowdfunding platforms, but you're not having to keep you up at night with writing $100,000 or $50,000 checks on those big, larger syndication deals. So, but this is a way to really access those institutional quality investments that are still passive because you're investing it with the operator who, like in this debt fund, Mark and his team and Brian Fine, they're sourcing out the borrows. They're underwriting, the note to see if it's a good deal because they are utilizing their investor capital to loan out that capital. So we're placing our faith that they know far and wide what they're doing as far as a lender and how to lend that capital to borrowers. And so where that we're going to get paid back with our interest and our money is going to grow. And so that is what you're doing with passive investing. So I call it the sweet spot is because it is that, 5 to 10K where a lot of people don't have 50K a month or a year, but a good number of investors, whether, and this is, you don't have to quit your day job, but a good number of investors may have 5, 10K every so often, whether it's once a year, twice a year, 3, 4 times a year, every month, even depending on your financial situation, where you can pool it with others, be exposed with a lot less lower capital risk, but still get into those high quality, proven track record, nice sponsor type of deals, and really be able to put your money to work as opposed to you always having to trade your time for dollars. So that's my story, and I'm sticking to it. I'm an advocate about passive investing. I'm passionate about building passive income. If you're in that 5K or 10K range and want to see how you can step into bigger deals with an investment group, I'd love to connect with you. I'll put my contact information up here on the screen. But that is how you can really start to build passive income at every level, whether you're starting at $5, $10, 50,000, 100,000, or what I call that sweet spot at that 5K, 10K range.
John Sledis, you are on with Terra Padgett. What's your question?
Hey, how you doing all?
Hello.
So, hi, thanks for taking me here. So my question is come here, Ben. My question is are the kind of passive income opportunities that you're talking about, are they pretty much like only like a long-term kind of thing? Like you get into it, it's like a 5-year commitment or 2 years, or like a time commitment to those kind of investments, or is it just you can take it out whenever you wanted?
Yeah, no, so it varies based on the deal. So typically, as we all will know, real estate is a long-term play to really make money. There are short-term investments, but in the club, we typically target midterm deals. So short-term being like 1 to 2 years, midterm, I'd say 3 to 6, long-term being 7+. So we typically target around that 3 to 6 year range. So it is each deal, of course, is very specific on how long. They'll tell you at the front of the deal they expect this to be a 2-year hold or a 5-year hold or whatnot. So it just varies. But it's once it's in the deal, it's most of them are not an opportunity where you put in your money and say, okay, I want it back tomorrow. Not like a quick checking savings account. So it is locked up for whatever the sponsor advises at the front end is the whole period.
So there is a 6-month period though, one that you have. This is the shortest term you said. Is that right?
It's deal specific. It depends. Yeah, it could be. So if there is a deal like someone is saying, we expect this deal to close out in 6 months, then yeah, and if we bet it and want to invest in that deal, then yeah, the deal could be 6 months. But the operator or the whoever we're investing with, they'll advise what that projected timeline. So like with the Always Capital Fund, I believe that's a 5-year lockup. JJ, correct me if I'm wrong, or Mark, correct me if I'm wrong. I want to say it's a 5-year lockup. But so there are varying levels of deals that we've done in the club. Some were a 1-year deal, some were a 5-year deal, some are a 3-year fund. So it really just depends on the deal. So there's varying levels to the different deals, and you kind of pick which one fits your preference. If it's money you think you're going to need in a year or so, look for those 6-month, type deals. If it's something where it's like, this is retirement money, I can't touch it anyways without getting 20% penalized on it, then you can do those, say 5 or 6 year deals. But generally speaking in the club, we look at anywhere from 3 to 6 years. Just as you understand, real estate is a long game, and it's not, unless you're doing a fix and flip. But even on fix and flips, we're looking at commercial assets. So when they're like flipping, say, a multifamily project, that's still, that's still at least value a 2 or 3 year minimum time to really go in there, renovate all units, get it stabilized and sell.
Bryce, you're on with Terra Padgett. What's your question, Bryce?
My question is this basically a fund of fund model, or are you just basically helping kind of guide the investor? Because I've heard something recently in regards to change in law for the fund to fund things, and I'm not too privy on it. So I guess I was asking if it's a fund to fund sort of model, and you're basically looking at other opportunities to invest in and not really being a general partner in a sense, but more of like a liaison.
Yeah, so it is an age-old investment club. So it is not a fund of funds where I am directing people's money or telling you what to invest in. So in investment clubs, this is I'm curating or bringing deals to the club to review and to vet. And if we decide we don't want to do it, then we don't invest. Or maybe if 10 people want to do it and 3 people do not, then just those 10 people will do it. So in the relationship is a GP-LP. So GP being the general partner, where they are doing all the sweat equity. They are, finding the asset. They're sourcing the loan, the debt. They're creating the documents. They're filing the stuff with the SEC, all of that. We are the LP. We are the limited partners. So they're property managing, they're asset managing. We are just investing our capital, and they're to be good stewards of our capital to pay us back with our expected returns. And so it's that GP-LP relationship. But each member makes their own decision based on what they desire to invest in.
Understood. Thank you.
Mark Abramovich, you're on with Tara.
So actually, Tara, I wanted to mention something. It's for everybody who, when you hear about an investment club, I'm actually a member of one as well. And what you gain is collective bargaining power. Because in my case, what ended up happening was I'm in a group of investors where the general partner, they were offering different kinds of returns, right? If you invest whatever, $500,000, you're getting this kind of preferred return. If you invest over $1 million, you get a better return. And so what ended up happening is I didn't have necessarily, or each of us individually doesn't have $1 million, but collectively we did. And so even though I only invested whatever, $50,000 into the deal, I'm getting the preferred return of $1 million investment because I'm part of this larger pool. As an investment club, we brought over $1 million, even though individually we didn't. So that's what you gain, even though it's not a fund of funds, but because you've got that, what I call collective bargaining power.
Yeah, there's a lot of advantages by doing it with the club. Like you said, you're pooling your capital to be able to hit certain hurdles. Like certain sponsors will give you more, a more preferred or a higher place in the capital stack, or maybe a higher preferred return if you're bringing a larger check size, like you said, $500,000 or $1 million. You're also pooling your own knowledge, as opposed to me just having to look at every deal and figure out, is this something I should invest in? If I'm in the club with Mark is bringing his insights. I'm bringing my experience. JJ's bringing his. Bryce, you're bringing yours. And so things that I might not even think of, you thought of, and you asked the question. It's like, oh, that's a good way to look at it. I'm also a part of another club. Even though I have the one that I lead, I'm a part of a club. And they always think I'm the insurance girl, because that's my background is in property casualty insurance. So we're looking at multifamily on the coast and stuff. I'm like, no. I know that valuation is down or up, and I know the insurance costs as the market is turning, because that's my professional background. So there's a lot of benefits to that, and it's deal flow. So where I have deals, but as people in other clubs are seeing other deal flow from different operators that they have relationship with, it keeps the deal flow coming into my inbox. And so I'm not going to invest in all of them, but the ones that I like, I'll invest in, or pass on the ones that I don't. So you're really getting deal flow. You're getting that community to help vet deals together. Once you hit certain capital check writing size hurdles, you can start negotiating those preferred returns. So that same, say, 10, like in our club, $10,000, as opposed to earning a 70-30 split, you might get to an 80-20 split, or as opposed to a 7% preferred return, they might bump you up to an 8% preferred return. So everyone, you really, the rising tide lifts all ships. So by pooling it together, everyone gets to benefit from the collective bargaining power of being a part of that club. And again, each person can make their own decision if they even want to invest in the deal. So we've had deals where no one wanted to invest in, so we moved on and looked at another one the next month.
Bryce, you had a question or comment?
Yeah, sorry about that. I just didn't see a way to register for your investment club in the presentation and didn't know if you had like a registration page or something like that.
Yeah, it's on the website. Just go to powerpoolfund.com. There's a button on there that says join the club.
And that's www.powerpoolfund.com, guys, just like the word that's behind it there. Kathleen, you're on with Terra Padgett. What's your question, Kathleen? Right, I think that might have been for Mark, but what's your question?
Yes. What if one wants to loan? They don't have money to invest, but they would like a loan. They still join on the loan part, or how does that work?
That's probably where you want to talk to Mark and myself, Brian, our team at Always Capital. Mark, you want to address that?
Yeah, and I can also answer that. Go ahead, Mark, but I can also follow up with that.
About borrowing, sure. Visit our site at alwayscapitalllc.com. There's a button that says borrow funds, and fill out the deal form for whatever you need, and we'll respond with a quote.
Okay.
Yep.
Simple.
And with that, when we vet the Always Capital Fund in there, we will be indirectly loaning to you, Kathleen. If you get approved, that's why we know that Mark is the lender. Brian Fine, JJ, they're on the lending side. So when we're pulling our capital and we invest into the Always Capital Fund, really our money is being loaned to you, but through our partner, our general partner, which is the Mark and JJ and Brian, them in the Always Capital Fund.
Okay, that's good.
And so that's one of the beauties of the passive investing is I don't know all the details on how you select proper borrowers, but I know Mark does because I know he has his own lending institution.
Corell, you're on with Tara. What's your question?
Well, I was just asking if a deal that you all invest in goes sideways, essentially, how are the risks mitigated? I know you're pooling and diversifying.
Yep. So that is loss of capital is always a risk in every investment, whether you're in real estate, stocks, doing direct deals, indirect deals. Loss of capital is always a risk that is forever there, no matter what you're investing in. So with that, the idea is that as opposed to you being out $100,000 on that, if that deal goes sideways, you're only out, say you're $5,000 or you're $10,000. So, but when the work as a passive investor and as a limited partner or an LP is on the front end. And in vetting the sponsor, vetting the market, analyzing the deal, understanding your own risk level, your own risk tolerance level, and what that deal is. If things are still, too risky for you, or the downside risk of that is greater than what the upside, then that's probably not a deal that you should be investing in. So understanding that and understanding your risk profile is where you're mitigating that risk, and you're only putting in those smaller amounts of capital to where you don't lose your shirt. You're not going bankrupt, and if an investment does go south. So, I mean, I know in the marketplace right now, multifamily is really struggling from the deals that were, put together in say 2020, 2021, where interest rates were really low. And now those adjustable rate mortgages are coming due, and they just don't have the money for the rate caps. They don't have the money to keep up to complete renovations. There's a lot of deals out there like that right now. And so the idea is that because you did your part on the front end, deals if you've ever done a deal yourself, they can go sideways. You can lose money on them. Things don't always go as planned. I reviewed hundreds of pro formas, not a one, even my own, never go exactly to plan. Maybe it goes way better than expected. Maybe it goes right around the middle. Maybe it falls short. But the idea is that you are partnering with those seasoned, experienced operators. And a lot of times, like in the club, I don't recommend doing guinea pig deals, meaning I don't want a new operator or a new operator, sponsor, general partner, kind of using those terms synonymously. I don't want to put my money with them to have their learning curve with my money exposed. And so the idea is that you are vetting that operator, because there will be, ups and downs and ebbs and flows as the market, triangulates and circulates. And so, but you're putting your faith that sponsor knows how to navigate those rough waters. Why? Because they've been through different market cycles. They've seen things, that to look out for. They've underwritten it conservatively enough. So if things don't go as expected to projections, you're still you still have wiggle room for deals. So maybe you don't hit that 20%, return, but maybe they fall at 15%, which is still a plus, still a win. So you're really mitigating that by understanding your own risk tolerance, by only putting those smaller amounts of capital in that, what I call the sweet spot, that 5 or 10K. But there absolutely, don't let anyone tell you that there's zero risk in investing, no matter what you're investing in: crypto, real estate, even they can be a run of the bank. So even in savings accounts, if you got enough in there, they can be a run of the bank and you can lose funds. So, but taking those smaller amounts, you're really able to mitigate the risk. And once your portfolio, where you've got 5 or 10K and, 100 different deals over time, that may not happen in year one. One deal really isn't going to keep you up at night. Nobody wants to lose any amount of money. Warren Buffett's rule number 1: don't lose any money in investing. What was his rule number 2? See rule number 1. So nobody wants to lose any amount of money, but it is, people would be lying to you to say if it is not a risk when you're investing, but everything is a risk. And so we're just taking those steps to mitigate that risk, with smaller amounts of capital, and vetting those sponsors on the front end before we decide to invest.
And so if someone wanted to invest in your fund, is there a fee to get into your power pool fund that then is investing into Always Capital LLC?
Yep. So we have, so our memberships are $65 a month. So if you join into the investment club, into Powerful Fund, $65 a month, and then now you have access to be able to do all those deals and pool those funds together to be able to access those deals.
Thank you.
Thank you.
And Carell, to add to that, with Always Capital, Mark and Brian are absolutely amazing, and they have over 1,000 deals between them that they've done and underwritten, and have a wealth of experience. So we at Always Capital are not just going to have somebody come in and say, "Oh, we've underwritten the deal, here you go," but we're going to underwrite that ourselves and make sure that we bring our experience and our knowledge, and not just one of us, but all 4 of us, predominantly Mark and Brian, as they have the wealth of experience in the underwriting and doing deals. As again, those 2 guys have done over 1,000 deals. Mark has been doing this for many, many years, and the amount of experience we have is part of what's going to minimize that risk. So,
Yep. And JJ, we could talk offline, but actually, once we get on the calendar, maybe we can invite everyone to our club call where we do vet that deal and show them, real time, what we're looking at, getting the pitch deck or the webinar or whatnot, and asking the questions back and forth. I can share things of how I do and how I review, a deal, and other people that have done deals before may have their ways that they were doing.
exactly.
And just hearing the Q&A, maybe we can invite everyone to that. And so if they join the club, they'll be able to pool into that, but just invite them to this open call, and we vet, we vet the deal. We vet the Always Capital.
Exactly. Carell, did we answer your question?
You answered them both. Thank you.
You're welcome. And everybody, I want to point out, Tara is not new at this. She has a wealth of experience. She's extremely sharp, as you can tell. And I have all the confidence in her. And just as any deal that would come across our path, Tara's path, Mark's path, anybody's path, we always want to do our due diligence and vet that the best we can, which is why we underwrite, why we analyze the deal, as they say. Well, guys, if we don't have any more questions, we can kind of wrap up a little bit and possibly go in some breakout rooms and do some live networking. Tara, if people want to get a hold of you after the fact, watching on YouTube weeks and months down the line, what's the best way to reach you?
Yeah, they can shoot me an email. I put it in the chat at info@powerpoolfund.com. They can peruse and learn more about the club on the website, powerpoolfund.com. I put that in there. They can also schedule a call or join at Powerpool Fund, and follow on all socials at Facebook, Instagram, YouTube, all at Powerpool Fund. Powerpool Fund on all socials.
Here is your Instagram for Powerpool Fund. So you guys please follow the fund, and then here's your personal Facebook, and then of course off her personal Facebook page, she's got the link for her business page, which again is the Powerpool Fund. So everybody, please feel free to follow her on Instagram, follow her on Facebook, and again, of course, we have the website up as well. If you guys would like to connect with me or follow what we're doing with the group, please scan the turquoise QR code. That will take you to my website. There's a register now button. You can register for the group. If you'd like to follow our YouTube channel and see all the 350 plus recordings we have of guest speakers, please scan the purple QR code. It allows you to subscribe for the group. Tara, I'm going to say thank you so much for jumping on. Hang on, we're going to get back with everybody else.
Okay.
And for those watching on YouTube weeks and months down the line, they can follow you and I on social media, right?
Yep, absolutely.
If you guys are on the call right now, don't go away. We're going to get back to Tara. We're going to have a couple more questions. And if everybody else watching on YouTube, thank you so much for participating. Please follow Tara's on her socials and myself. I've got my YouTube and my website. Please connect with me and let's help you grow your business. And again, uh, my new lending company is Always Capital, LLC.com. So please follow us there as well. Thank you guys. If you're on the call, don't go away.